this godforsaken, yield-starved world, guess what people want? You guessed it, dividends and more dividends. And who are we to deny their request? Welcome to ETF Battles. I'm Ron DeLegge, and today's ETF battle is between two dividend growth-focused ETFs. We've got the Vanguard Dividend Appreciation ETF, as ticker symbol VIG, versus the iShares Core Dividend Growth ETF, as ticker symbol DGRO. And we've had multiple requests for battles between these two dividend ETFs, and now the moment of truth has arrived. So which ETF is the better play for dividend growth? Well, you're about to find out. Keep in mind that both of these funds combined hold just shy of $63 billion in assets. Now, that's a lot of bananas, and it also means the stakes are very high. So before I introduce our judges, be sure to subscribe to ETFguide TV, and don't forget to check out our new weekly show, the Portfolio Report Card, where I analyze and grade your investments, and do not miss it. Well, judging today's matchup is John Davi at Astoria Portfolio Advisors and Mike Akins at ETF Action. Judges, it's great to have you with us.
Good to be here, Ron. Mike?
Great to be here, Ron. Thanks.
So this is also the first time we've got you paired up as judges, so we're glad to see you guys both in the saddle together. So the four battle categories between VIG and DGRO are cost, exposure strategy, yield, and performance are together, and then we've got the mystery battle category. And so our judges will weigh in. Each of them are going to have 30 seconds to give us their view on which of the ETFs in this battle win each respective category. We'll also declare at the very end of the show an overall winner. And we're going to start with the first category, which is cost. Let's start with Mike. Mike, you've got 30 seconds. Go.
These are both very cheap, very liquid strategies. I think one's 8 basis points, the other's 6. So I think depending on which vehicle you want, if you want a little more higher yield or a little less yield, a little more growth, really comes down to strategy, and cost is not a factor. They're both fantastically cheap.
Excellent. That's a great start. Let's shift to you, John. Which ETF wins this battle in terms of cost?
So I have no pushback against what Mike is saying. VIG is definitely a couple bips cheaper, but there's other things that I think are significantly more important than cost. Things like exposure, sector exposures, composition. Those to me are much more important than cost. When you get to something that looks similar, but they're actually quite different if you look under the hood.
Okay, so in terms of cost, split decision?
Cost would be Vanguard VIG.
Okay, excellent. Let's shift to the next category, which is exposure strategy. You're still up, John. Which of these ETFs wins the battle?
I would give the nod to VIG, the Vanguard product. They're both very different in my eyes. VIG has 200 stocks. DGRO has 420 stocks. VIG is tracking a market cap weighted index of U.S. stocks that have increased the dividends for 10 or more years. DGRO is focused on dividend growth, but you wind up getting a ton of financial stocks. So if you look at the sector composition, financials make up of about 18% of DGRO versus only 7% in VIG. And, we're recording this today on a day that, there's, a news announcement, from the COVID vaccine from Pfizer. And banks are up significantly today. The KBWB bank ETF is up 12%. So that bodes well for DGRO, specifically for today. But what you'll see is that, over the course of the last year and few years, DGRO has underperformed because of that value tilt towards financials. So you got to really be careful. I give the edge ultimately to VIG just because I think they have a little bit more of a comprehensive sector exposure than DGRO.
Very good. Let's shift to you, Mike. How do you see it in terms of exposure strategy between these two ETFs? Do you agree with John's analysis?
I agree with his analysis, but not his results. I'd give the nod to DGRO. We classify DGRO as a dividend multi-factor strategy. We classify VIG as a dividend growth strategy. So selection is very unique here. VIG is going to focus in on companies that continue to increase their dividend year over year for a very long period of time. So it's agnostic to any other fundamentals. It's all about, has it continued to pay a dividend? As a result, you get a portfolio that's I would consider it more of a quality portfolio. These are companies with very strong balance sheets, they have a tilt towards defensive nature. So if you look at VIG's long-term track record, it has a very low up and down capture. So, when the market pulls back, VIG tends to do very well. When the market goes up, VIG tends to trail. So DGRO, on the other hand, is going to take a number of different fundamental factors to end up with their ultimate portfolio. The end result is VIG looks a little more like a growth portfolio, and DGRO looks a little bit more like a value strategy, right? So DGRO yields about 3% on the underlying. VIG actually yields a little bit less than the S&P 500 as a whole, about 2%. And the result is a value tilt. As John pointed out, a big part of that is that financial overweight. But from a standard, I'm a bigger fan of multi-factor strategy when it comes to the dividends space. I think that a simple screen like dividend growth is picking companies that grow their dividend is fine. But at the end of the day, it also limits certain holdings for very random events, such as the financial crisis, which is why VIG has such little financials right now. So going to give it to DGRO on the strategy. I'll leave it there.
All right. And that takes us to yield and performance, which is the next battle category. John, you're up. How do you see it in terms of yield and performance between these two funds?
Yield goes to DGRO. You get a higher dividend yield when you buy that product compared to VIG. So overall, if everything Mike has just kind of eloquently explained, I think that translates into a higher yield for DGRO. So I'd give it to DGRO in this battle category.
Okay. And you've already alluded, Mike, and we're going to shift to you, Mike, in terms of yield and performance. You already kind of touched on this, but you're still up in terms of yield and performance, this category. Who wins the battle?
So yield clearly goes to DGRO, and performance since common inception, which is pretty good track record, June 11th of 2014. It's really close. VIG's outperformed by about 3%, but in big differences, right? VIG was underperforming up until the big drawdown this year, and VIG showed its merit as a defensive portfolio and caught up with it. So since inception, VIG has outperformed slightly, but I'd still give the nod to DGRO as a better representation of the overall market. If you're looking for a core portfolio with that yield, I'm going to give it to DGRO, but both uniquely different strategies at the end of the day when it comes to that composition.
All right, that takes us to the next battle category, which is the mystery category. This is where our judges can pick that one factor or maybe several factors that they feel are crucial to today's battle. Mike, you're still up. What's your mystery battle category and who wins it?
Yeah, so my mystery category is going to be this idea of so it comes down to selection, multi-factor, kind of what DGRO does to build its portfolio versus simple strategies. I usually really like simple strategies. I think they're both really good portfolios, but I would point out that right now VIG does not own Apple. It does not own Pfizer. It does not own Coca-Cola. It does not own Merck. And these are all very strong dividend paying companies with a history of clean balance sheets, but they don't meet that stringent requirement for one reason or another of time period of increasing dividends. And I think that just, that to me is arbitrary, and I wouldn't exclude a company simply because it hasn't paid or increased a dividend for that long. So my mystery category is this methodology matters. And in this case, I give the nod to DGRO for being more multi-factor in its discipline.
All right, very good. Thank you for weighing in. And let's shift to you, John. How do you see it in terms of your mystery battle category? What is it and who wins it?
I'll stick with Mike's category about methodology. I think VIG wins because of the simpler methodology. So, specifically, it's companies that increase their dividends by 10 or more years. I don't know how DGRO actually calculates their indices. I haven't done that research. Mike, if you know, chime in. But to me, simpler is better. I can understand it. It's 200 stocks. I think whenever you go to like a satellite ETF position, the more concentrated, the better. DGRO 418 stocks, so significantly more than VIG, which then winds up looking like a core ETF holding. And I think that's the rabbit hole that people will fall into, is like they'll think they can use DGRO 400 stocks as maybe an S&P 500 placeholder, and then you wind up seeing massive slippage for DGRO compared to like the S&P 500. So I kind of like VIG. It's tight. It's 212 stocks. The companies that Mike mentioned before just don't have 10 years of paying more dividends. As far as why it's 10, not 25, I mean, there's different indices have different years of how they kind of pick these, cutoffs in terms of the number of increases per year. I think Noble's 25. VIG just happens to go with 10. I'm kind of okay with that. I like the simpler, the better methodology in this case. Over the past year, you've seen, more inflows into VIG, I think because it doesn't have that massive tilt towards financials, whereas DGRO underperforms because of that. So overall, I think that my category winner is going to be VIG just on the methodology. I'll take the opposite of what Mike said.
Okay. And just for full disclosure, too, John is a less is more guy when it comes to his cappuccinos. He's not one of these guys that has maca macchiato, apple sauce, sweet, right? It's just a simple, how do you drink it?
Just milk and no sugar. That's it.
Okay, less is more, like your choice here. So it totally makes sense. Thank you, John. So now we're going to shift to our overall battle winner. This is where you guys get to decide your overall winner between these two dividend growth focused ETFs. So let's shift to you, Mike, and then John will go after him. Who is your overall battle winner?
I'm going to go with DGRO. You'll be happy to know I'm not going to give it a split decision like I normally do. But I have to throw in a little bit of disclaimers there and say that I think a big part of what you're trading here is your bet on your macro assumptions, right? So if you believe a cyclical trade is coming back, that COVID vaccines for real, and the world's going to open up in 2021, I think that's a strong vote for DGRO. It's got a value tilt to it. It's got some of that cyclical exposure that you'd want to have in that type of environment. If you believe the market is overbought, you believe that we're still in a very volatile world, and they think there could be a big drawdown again in the near future, I think VIG will hold up significantly better. That consistency of those companies, those strong balance sheets, the wider moat names, if you will. So that's my caveat, but I'm going to give that to DGRO. One, because I like the methodology better, but two, I think it sets up for the environment that we're heading into from the economy right now. And I'm a big believer that the comps inside of DGRO are going to be easy to beat next year, and it's going to drive returns.
Very good. You're up, John, for your overall battle winner. Who wins it?
Overall, I'd say the Vanguard VIG product. It's cheaper. It's had better performance. I'm more comfortable with the methodology. I look at that as more, the satellite position. I kind of know what it's doing. It's pretty simple and easy to understand. DGRO, I still don't know how financials make up 20% of the ETF. It's had better performance, 1 year, 3 year, 5 year. It's had more inflows. It's cheaper. So I'm going to give overall the kind of battle category winner to VIG.
All right. Well, thank you, judges, for weighing in. And according to my battle scorecard, I unfortunately have to score this as a split decision. And the reason is because you guys only agreed pretty much on yield and performance, that particular category. DGRO was the winner in that category. And everything else was pretty much a split decision in terms of your outlook, which is okay. It's okay to have competing or contrasting opinions. I think there's a lot of great points and takeaways that you raised from each perspective. And I think at the very least, both of these ETFs, VIG and DGRO, if you're into dividend growth or dividend strategies, period, merit further research. So thanks again, judges, for weighing in and giving us your viewpoint on these two dividend-focused ETFs.
Can I jump in with one just general comment?
Yes.
VIG is probably one of my favorite all-time tickers of all time, but I just want you to know, just because it's VIG as a ticker, it does not hold DraftKings or Penn Gambling or any of those new online stocks. So don't confuse the VIG with what it's holding.
Thank you for highlighting that. Very important point. So it's your favorite ETF so much so that you didn't choose it.
Favorite ticker.
Oh, favorite ticker. Oh, I see. Gotcha.
Ticker. Yeah.
Gotcha. That makes sense. I'm sure that somebody out there besides you has been salivating for when it becomes available, which is probably never. Well, which ETF battles would you like to see in our next episode? Post your thoughts in our YouTube comment section below, or hit us up at Twitter. We're found at ETFguide, #ETF Battles. I'm Ron DeLegge. Thanks for watching. We'll catch you next time.